Would a person save more money with the P.I.L.L method on a 30-year loan versus a 15-year loan? I know I already have an idea of the answer for this one, Don, but we're going to let you have center stage here to answer this one. Wesley, buckle in.
All right, so we're going to put this right on the screen. All right, I've got that same $400,000 mortgage up here at 4%. All right, and it's a 30-year loan. Okay, here's the thing: when it comes to loans, okay, you focus on what's important. Do not focus on what's not important. So, what we have been taught to focus on is the term, whether it's a 30-year or a 15-year or a 20-year or a 10-year. We've been taught to focus there. We've been taught to focus on the interest rate, not the interest cost. We've been taught to focus on the payment. So, here's the whole thing: the reason why you get a loan to purchase your property is because you may not have the cash to purchase it outright, or you don't want to use your cash to purchase it outright. So now, what is the next thing you want to think about? How do I pay off the loan? Okay. Now, do we pay off the loan? What is the reason why we want to pay off the loan? Just to say that we've paid it off? Or is it because we want to save interest? So if the loan was 0% interest, there is no financial benefit to pay the loan off early. None. So then the reason why we pay it off is to save on the interest. So if we give you the wherewithal to cut your interest cost by 75 or 80%, then you automatically pay the loan off sooner because more of your money goes to principal, less of your money goes to interest. All right. So now, with that in mind, let's talk about 30-year loans, 15-year loans, 10-year loans. Okay. So if you have a 30-year loan and we plug it into the P.I.L.L method, and you know up front that we're going to cut your $300,000 in interest that you're supposed to pay on that loan, we're going to cut it down to $90,000 instead. Therefore, you're able to pay off the loan in 7 years. Why would you get a 15-year loan when you can pay off the 30-year loan in 7? Because now we're focusing on what really matters is interest savings and getting rid of the loan. So here's what I need to tell you. A 30-year loan on the P.I.L.L method, if you have the resources, pays off in 7. A 20-year loan pays off in 7. A 15-year loan pays off in 7. Let's go the other way. A 40-year loan pays off in 7. A 50-year loan pays off in 7 years if you have the same resources. Don't look where it doesn't matter. It doesn't matter how many years that they give you. What matters is how much interest can you save and when will you be done with the loan? And you can know that going in. Here's the next thing you need to consider. I've got a $400,000 loan on here at 30 years, and the payment is $1,909.66. You see that? So we're going to click over here. We're going to change this to another $400,000 loan. Okay. And instead of 30 years, we're going to make it 15 years. Now, do you see what I'm doing here, folks? I can know what my 15-year payment is going in before I start. The 15-year payment is $2,958.75. The 30-year payment is $1,909.66. So let's just say all I know, because you learned quite a bit today. Let's just say that all I know is I can get a 30-year loan or a 15-year loan. What you know is there's a 30-year payment and a 15-year payment. You can get the 30-year loan and make the 15-year payment. You don't need permission to have a 15-year payment. All you have to know is going in. And guess what? If you can afford to do this, to make the $2,958.75 payment, what if things get a little rough along the way? You're not stuck with a $2,958 payment. You can drop back to your $1,909.66 anytime you want. Never, ever, 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 ever get a 15-year note. Don't do it. Get a 30-year and pay it off in 7. Now, if you don't know anything about the P.I.L.L method, let's just say you don't know about the P.I.L.L method, okay? Then get your 30-year loan and you can make the 15-year payment just by putting it in a simple amortization schedule like this online, figure out what a 15-year payment would be, and make that. So you don't refinance to a 15-year, don't refinance to a 10-year, just with the loan you have now. Just figure out what the 10-year payment would be and start making it now, and you avoid the fees.
But Don has some valuable information that can contribute to the quality of a person's life, and it only costs you a few dollars. It's his book. Why not get that?
I'm going to go through the P.I.L.L method myself with some of my investment properties. So I'm going to link up with Don, and then I'm going to sit down with him, show him my investment portfolio, and see how I can eliminate interest.